Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. What we're going to be looking at today is actually not necessarily a specific market, but actually a very specific pattern. And then this isn't an Elliott wave pattern. It's actually an old school type chart pattern, a head and shoulders pattern, which was popularized by Edwards and McGee in their work. And if you're familiar with Futures Junctures or the Traders Classroom Collection ebook, on occasion I do talk about the head and shoulders pattern. And I really like the pattern, and there are a lot of the reasons why is because number one, it's easily discernible on a price chart. And number two, it also gives me a high probability objective. Now, with respect to what we're looking at here, this is a price chart of the 10-year U.S. Treasury note. And I'm showing you essentially the parts or the components of the head and shoulders pattern. What we have is essentially a left shoulder, a higher high for a head. Then we come down and then we push back up, and that actually forms the right shoulder. Now in this instance, because this advance we actually saw in prices in the 10-year did not move back up to the trend line, this top portion right here, I call this a half shoulder. But technically we can actually view this as a left shoulder, a head, and a right shoulder. Now if you connect the extremes between the left shoulder and the head and the right shoulder, that actually forms what we call the neckline. Now whenever that neckline is broken, what you can do, and this is where you come up with that high probability target or objective to the downside, whenever you experience that neckline break, what you simply do is measure the distance between the head to the neckline and then take that distance and project it downward. Now in this instance here, it actually projected around, say, the 128 handle, and that's exactly where prices fell to in the days that followed the formation of this head and half shoulder or this head and shoulders pattern in the 10-year note. Okay, now let me show you another example of a head and shoulders pattern, but this is in an individual stock. This is Microsoft, ticker symbol MSFT, and this is what the 120-minute price chart. Now again, you can see the components of the pattern fairly clearly here. What you have is your left shoulder, here's your head, and right here we have our right shoulder. And again, the extremes or the low that forms between the left shoulder and the head and the right shoulder, simply draw a trend line between the two extremes. That gives us our neckline. So what we want to do now here is measure the distance from the head to the neckline, and then project that distance down from the breakdown point, which is right here. And as you can see, that actually targets around, say, the 30.50 handle. Now, as you can see, the market hasn't opened yet. We closed yesterday at 31.10. So as we move into, say, today's trading or tomorrow's trading, I will be looking for further decline here down to, say, about the 30.50 handle. Okay, now let me show you one more final example of a head and shoulders pattern. And again, it's very exciting here because the neckline has not been broken yet. This is the euro. Okay, this is the cash euro. And what do we have here potentially, again, is a left shoulder. Here's our head. And here's our right shoulder. And as you can see, what I'm doing now is drawing the neckline. Now the neckline again is the trend line that connects the extremes between the left shoulder and the head and the right shoulder. Now as you can see, we have not seen a decisive break or a penetration of the neckline. So in other words, prices could go up, they could go sideways, they could travel sideways, but if we do indeed, say within the next, say, 5 to 8 trading days, do indeed encounter a decisive break of that neckline, well, all we have to do at that point is then measure the distance between the head and the neckline and project that distance down from the breakdown point, and that will give us a rough target or a very high probability target, I believe, with respect to the extent of the anticipated decline, which would actually target, say, the 125 handle, which would actually be back to below the January low we saw earlier this year. Again, simple pattern, easily discernible on a price chart, and one of the reasons I like it is because, again, it identifies a high probability target for the subsequent move of a breakdown or a penetration of the neckline. That about does it for today. Thank